We had to wait patiently, and the market finally sold off. It's bottomed out right here. It's kind of rebounding. I still think it's a good spot to balance the hedge. So I am holding 9,342 units on the short side right here. It's time to probably balance that hedge. We've waited for a while. It's rolled off. It's starting to pick back up. So just to be safe, we had a pretty good pullback. I'm going to pick up 9,342 units right here, which will balance our hedge. So now we have 9,342 units on the long side, and we have 9,342 units on the short side. Now we're fully balanced, 9,342 units long and short. Pick that up. That's already covered the 2 pip spread. It just flashed down and then is pulling itself back up. So on that, that's where I picked that up, is on this 5-minute candle. Just flashed, grabbed it in this neck of the woods, and it's popping back up. So the idea was waiting, and it took a few days for this to finally kind of trickle down and get down into a zone that felt like was a good spot. We made a little bit of money, pulled back our drawdown to a respectable number, and now we're just cooking away, seeing if we can't pick up a little more money along the way. What we're looking for now is if it bounces and climbs back up into here, this will be a in the money trimming position. If it continues to sell off, then down here would be our next in the money trim position. Well, that might have worked out all right. So this position right here, it got just above 40. I missed it at 40, but we're sitting at 36.5 pips in the money. So let's trim the hedge. Let's call that 35 in the money, and this one is going to be out of the money, 91. What we'll do is we'll close this guy. This is our in the money position. We'll have a profit, a total profit of $24.85. We're going to keep $6 and apply 1864. So out of this 9,342, we'll trim it off by 2,695 units. Actually, we might be able to do a little bit more. That's kind of creeping up. Let's call this 36, and this one is minus 92, 2742. So what we'll do, let's set these up. This one's going to be our partial close of 2742. This one will be a full close. So let's drop him, partially close him. So now we are down to 6,600 units on the short side and currently holding nothing on the long side. That's nice. All right, so where did we close that guy at? We closed him at 1.35906. That's where we dropped him. Ideally, we get that back down below that, 5, 10, 15 pips, 2, 3, sometimes 0, you just don't know. And that's where we'll want to pick back up that hedge. I don't think I'll wait as long as we did on the last one, because it feels like the overall momentum has kind of shifted the tide. We were in this downtrend. Now we've got this big, long, bullish bar right here, which could put us back on trajectory to the upside. So, you want to get it down below, but you don't want to get super greedy if it's not showing signs of rocking and rolling in your direction. So we closed that out at 906, that blue number right there. It's currently on the buy side 913. So we're not quite back to break even as far as covering our pip spread. So anything below 906 on the buy, that's money. I kind of like this right here. We've gotten a 5 pip pullback, which is a pretty good win. It's currently at 861, 859 right there. We closed it at 906. So it's about 5 pips that it's come back down. I don't know how much more it's got in them. So I'm going to go ahead and drag this buy stop order, drop it into the market zone, hit modify the order. That's going to instantly just pick that up. It turns it into a market order is what happens. So the pip spread right here, that's the spread on the market. And, it's obviously come back off a little bit. It'll bounce around right there. But now we are fully hedged, back balanced at 6,600 units. So we've got a few units back. And we are now waiting to see if we can get this to move in the right direction yet again. We're looking for 40 pips this way or a sell off 40 pips this way. The other option we still have now after the trim is we've got 5,900 units that are sitting on the sideline for potentially a nice trade somewhere along the way. Pretty good morning. It's time to answer some questions. All right, let's get this thing cooking over here. One person wrote, Chad, what's up? What's up, my friend? How you doing? So basically, the method allows you to move the average price, in parentheses, of your accumulated position when market goes against you. What's the worst thing you can hit using this method? Ending up with two tiny positions, hundreds of pips apart. This relies heavily on some kind of reversal at some point, preferably not picking up the hedge, right? Okay, lots to unpack. Lots and lots to unpack. I would say everything you said is mostly correct and could be 100% correct for you depending on how you decide to manage your hedge. The one thing I want to point out is you wrote the average price. You actually do not have to trade from an average position if you don't want to. You can have positions close and pick up other positions along the way. So I think in the last video, I had 2 long positions. I closed them individually and worked them separately. You could have worked an average price if you wanted to. It's totally up to you. In this position, I have only a long and a short, but let's say I had another long position up here. And this was the one that came into the money. I could take this position when it was in the money 40 pips and trim the furthest outside opposite position without working an average price. So this position works in the money. It trims the outside position and it brings these units to the market plus the units you use to trim. I wouldn't say it has to be average, but now let's talk about this in another respect. Let's say you had a position here and a position here, and the average price between the two was in the middle. You could trade off of the average, and that would help you collapse 2 positions on the long side. So the answer is 100%. You can average them or you can individual them. Let's say you had 3 positions staggered up. Maybe you took 2 positions and averaged them, or maybe you took all 3 or just 1. The point is, it's totally up to you how you manage the in the money positions as you work a trim on the outside opposite position. It's not an averaging down. We're not averaging positions to get you close to the market. However, if that presents itself, I do it. I do it. Sometimes I do it. It's crazy. Sometimes I average 2 positions. The second part is you could end up with 2 tiny positions hundreds of pips apart. This potentially could be true. So let's say this market all of a sudden got on its high horse and went straight up, and all we did was just whittle away at this. Eventually, this position on the short side could be out of the money hundreds of pips, 300, 400, 500 pips. But every time you trim it, it gets smaller and smaller and smaller. And then you bring those units to the market. And eventually, those units become big enough when they're in the money, 30, 40 pips, they easily take out a small position on the outside. Or you could easily have that small position and average it with a big position up here. So for example, let's say this position was 600 units and clear up here, 600 pips out of the money. I mean, we're like way out. Like, holy cow, the market went straight up and we're like clear up here. How many pips would that be? That would be 400 pips out of the money. We're like, the market just went and we just kept whittling away, whittling away. So then you had, let's say, a 8,000 unit position up here, and it went into the money, and you had a 600 unit position down here. Eventually, that position on the top side, he might only need to go an extra 5-10 pips in the money to wipe this guy out. So another opportunity to average on those positions, or you can just continue to wait and let this one on the long side continue to go up, and you just keep whittling this guy away. Eventually, he just whittles and whittles and whittles away to, to nothing. There's got to be like a old man analogy there, that eventually we just whittle away to nothing. That's called trimming the hedge. Let's see. This relies heavily on some kind of reversal at some point, preferably not picking up the hedge. It can. That's one very important way you can reduce your drawdown, is a reversal and not picking up the other hedge, or you have units that are on the side. I have 5,900 units out here that's on the sidelines waiting for an opportunity to go in. Let's say I was like, dude, I really like it right here, and I sold 5,900 units, and this continued to come down, and I picked up 10, 15, 20 pips, and then I close that position out without hedging. That would be a clean trade. 5,900 units come down. We did not hedge. We just made 5, 10, 15 pips on that trade. That's a clean trade. So you can get a reversal like what we did this morning, where we dropped it, you reeled it back, made 5, 6 pips on it, or a big reversal like what we had over the weekend, where we held it and allowed that to work back into the money. Or you can have units on the sideline that you could pop in, catch a clean trade, so you didn't have to hedge it. You were right instead of wrong, which is like going to happen accidentally. You're going to be right once in a while. You can't always be wrong, although it feels that way sometimes. And that position just makes money without picking up the hedge. Clean trade. So those are the two main ways you make money: clean trades or catching the pullback unbalanced on your hedge. Trimming the hedge allows you to put money in your pocket and reduce shares or units that are out of the money. But eventually you do have to catch a clean trade or catch a pullback. You have to work the hedge. You have to make decent trades along the way. So it's a little bit of back and forth.